Κυρίες και κύριοι, καλημέρα. Ladies and gentlemen, good morning. It's my pleasure to moderate a very distinguished panel. The issue is very, I think, pertinent to what's going on in Greece right now, threats to European recovery. So I suppose we'll talk about the European situation overall, but then the Greek situation and how what's going on in Europe affects Greece and how Greece also could affect Europe. And we have four very distinguished panelists with us. Ms. Helga Bartsch, who is the European Chief Economist of Morgan Stanley. Mr. Peter Bofinger, who is a member of the German Council of Economic Experts and a very well-known figure to the Greek audience. Engelbert Stockhammer, who is a professor of economics at Kingston University in England. And Andrea Terzi, professor of economics at Franklin University in Switzerland. The format is you each have about 20 minutes for a presentation, and then we have a discussion among ourselves and with the audience.
Good morning, ladies and gentlemen. What I would like to do in the next 20 minutes is talk about the European recovery, and I would like to broaden the view a little bit to some of the long-term factors that might hold back growth. I will talk a little bit about the risk of secular stagnation in Europe, which is driven by a number of factors. One is the deleveraging need across several sectors, both public and private, the aging, which is quite advanced on the European continent, but also topics such as energy policy and geopolitical tensions, because I think that much more than the US, where this sort of debate about secular stagnation has started, I think this is a risk for Europe. And in this context, I think it might be interesting to look at the German economy, because the German economy is one that is operating near full employment and should also have no major impediments in the availability of credit through the banking system. Nonetheless, we see a pretty profound degree of underinvestment in the German economy, both by the private and the public sector, and I think we need to look a little bit more into that. I will talk about the role of structural reforms, notably the liberalization of product markets, but to some extent also of labor markets, and sort of some of the long-term challenges that might arise in the labor markets based on the current very deep, or the past very deep downturn that we had, and the sort of permanent problems that it might create in the markets. I know we have another section about the labor market after this, so I won't spend too much time on this. But then we briefly need to talk, I think, about how these problems are exacerbated by the current lowflation, or I would maybe even call it noflation situation. And then I want to talk a little bit about what could be done to support this from a monetary policy perspective to actually foster the recovery through creating a credit impulse. But let's look at the long-term growth outlook for the euro area here. And unfortunately, it's not great. It looks very likely to us that on average for the next 10 years, Europe will struggle to deliver growth rates that average more than 1% in real terms. And this is based on sort of the estimates on potential growth of a variety of institutions, our own assessment. But the good news is that this low potential growth rate is not cast in stone. It could be increased by structural reforms, because at the moment in Europe, an enormous amount of entrepreneurial talent and also, I think, human capital in the workforce is buried under red tape. And I think it's quite important that we address this and push through with some of the structural reforms, because it's pretty clear that we also have a trend decline in total factor productivity, and that will probably not get any better if we have sort of no renewal in the capital stock. And that is why I'm so worried that we see this profound weakness in investment spending, not just in the periphery, but also in the core countries and the largest countries in the euro area. So I really think we need to look into this a little bit more in more detail. And I would like to draw your attention to what's happening in Germany. As you can see, for more than 10 years, investment spending in Germany was surprisingly weak. The share of investment spending in GDP is very low indeed. That's in part because Germany did not have a housing boom in the vague or in the very low interest rate environment. We might have a mini housing boom at the moment, and we see a pickup in residential construction activity. But on the whole, Germany has underinvested quite materially. And very interesting, I find the chart on the right-hand side, which tells you what the government has invested over after depreciation. And you can see that in Germany, net fixed capital formation in the government sector has been negative for more than 10 years. So that means that as far as public infrastructure is concerned, Germany has not replaced the wear and tear of the infrastructure. And some of you might have heard about sort of anecdotal evidence about German roads having more and more potholes, and some of the bridges, which are more than 100 years old, sort of having some structural weaknesses, and therefore finding it more difficult to take heavy, either heavy trains across or heavy goods vehicles. And this is, I think, quite important because obviously with Germany's location at the center of Europe, if the German transport infrastructure doesn't work very well, this eventually will affect all of Europe. Now, these numbers that I show there on the right-hand side might be slightly biased to the downside because we have had some privatizations at the local government level, at the municipality level, so some investment spending might have migrated to the private sector, but on the whole, and as you can see on the left, Germany is not investing enough. And this is, for me, one of the key reasons why Germany has very little reason to be proud of the current account surplus. Because in my mind, the current account surplus is a sign of investment weakness. And here you can see why. On the left-hand side, you see the chart that you, I'm sure, have seen many times before. It shows you the composition of the current account surplus and how it's driven by this sort of standard breakdown or into the trade balance, the income balance, and so on. But the key chart is the one on the right, which shows you the savings investment balances by sectors. And I would draw your attention to the yellow bars. That shows you that for the last 10 years, the German corporate sector has been a net saver. Now, this is very unusual for a corporate sector to be a net saver because the corporate sector normally should be bursting with new ideas, new technologies, new product ideas, and they should be net investors. They are, of course, also the sector where these savings and investment balances swing most across the cycle because it's maybe the most cyclical sector of our economies. But this has been going on for 10 years. It's partially related to a shift in the German corporate tax regime, which made it a lot easier to retain corporate profits, which was introduced by the Schröder administration. But the fact that the German corporates are not keen to invest in Germany, I think challenges the idea that Germany is this engine of growth in Europe. If the German economy would be as strong as people think it is or claim it is, you would need to see more investment there. And when you drill into the data and you break the investment spending down by company size, what you will find is that large corporates have a lower propensity to invest in Germany than small and medium-sized companies. And for me, that suggests that large corporates are also looking elsewhere for locations in which they can invest. And I think there are a number of reasons why they would do this. And the one that I think is quite important is the energy policy. The energy policy creates a very expensive cost structure in Germany. It also creates a lot of uncertainty for companies, especially those which are heavy energy users. And we, of course, are very close to signing a transatlantic free trade agreement. And we know that in the US, through the fracking revolution, you can be tapping into cheap energy for quite a long while. So I'm concerned by this underinvestment. And again, we're talking about an economy which roundabout operates at full capacity, which doesn't have an impaired banking system. So there's definitely more to this story than I think it's often discussed. When we look at how we could change the low potential output growth, I would just want to draw your attention to the chart on the right-hand side. These are some estimates that the OECD has done about the maximum impact on GDP per capita over a 10-year horizon if countries would embark on the ideal set of regulations as sort of devised by OECD economists. And the impact is potentially very strong. For the average euro area economy, we're talking about a 15% gain in GDP per capita over a 10-year horizon. Now, you could, of course, say, listen, what economists sort of in a think tank in Paris envisage as the ideal sort of and liberal degree of liberalization and deregulation might not be something that we will find in the real world. But some of you might have seen work that the European Commission has done, where they basically said, let's look at the 3 best regulated countries in Europe, and let's assume that every country reduces the distance to the top 3 in half. What would that do to growth? And that would still boost growth over a 10-year horizon in the average euro area country by about 5%. But in some countries, which are quite far away from the existing, let's say, regulation frontier, it's a lot more. So for Greece, on the European Commission estimates, you would actually be able to lift gains of around nearly 15%. Now, this is quite important because a lot of these regulations actually are about the liberalization of closed services sectors, regulated professions, and the main driver is not the labor market deregulation. It's really about creating more growth momentum in the services industry. And one country that is also lagging on this front is my home country, Germany. So there's definitely, I think, a reason to push on with supply side reforms to basically allow companies to grow and for new businesses to be created. And if you think back to the times when we were all wondering when the new economy would arrive on our European shores, one thing that we found out is that a lot of companies are founded in Europe. So we're not lacking the entrepreneurial ideas or the knowledge to do it. But once these companies are set up, they don't grow. In the US, they can literally explode in terms of growth, whereas in Europe, they often stay very small. They're very smart in terms of what they devise, but they don't have the ability to grow. And I think in many cases, this has to do with a lot of regulation that sets in for companies beyond a certain size. So in some countries, it's 50 employees, so you find a cluster of companies that have exactly 49 and a half employees in France, for instance. So this is, I think, very important, and I think, for me, sends a positive message. I said that I briefly want to sort of highlight how the crisis and the sharp rise in unemployment that we have seen could leave pretty long-term, create long-term pain in the labor market. And that's the well-known phenomenon of hysteresis, that in Europe we often see unemployment go up, but never really go down to the pre-crisis levels. And I think in this context, the rising incidence of long-term unemployment and of youth unemployment is particularly worrisome, and I would view youth unemployment in particular also as a sign of labor market exclusion, and I think that needs to be addressed. Now, a lot of debate at the moment centers around the question of whether Europe is going to become Japan and whether we are sliding into a deflation spiral. My worry is not so much that we are sliding into a deflation spiral. My worry is more that we get stuck in a low growth, no-flation equilibrium, where the ECB sort of doesn't manage to deliver on its price stability target, and where we are sort of settling for a situation of very low long-term growth. And in this context, of course, we have a headwind from the debt overhang in the public sector. We have a debt overhang in the private sector. And if we compare the extent of deleveraging that we have seen in Europe to the one in the US, I think we also need to bear in mind that it's not just the lower nominal growth that we were printing here in Europe that holds back the deleveraging process, but also a very different insolvency legislation. It is much easier to restructure debt, both for households and for corporates in the US than it is in Europe. And that, to some extent, means that there's still a millstone hanging around our necks, and that might be the case for a while longer. And that, a lot of people worry, will hold back the creation of credit. We know from the bank lending survey that banks have started to gradually ease bank credit conditions, but of course that follows 7 years of having tightened them, so I wouldn't get too excited about this at the moment. But when it comes to the credit cycle, I would stress that we really need to look at the right kind of variables. Most people look at the graph that you see on the right-hand side, the yellow line, the year-on-year rate of growth in the corporate loan stock. That's basically what the ECB publishes every month as part of the M3 report. I do think, though, that that is the worst possible variable to look at because it's so lagging behind what is really happening. For instance, if we look at the new loans that are originated and sort of signed for SMEs, for the first time in 7 years, these are printing positive again on a year-on-year basis. I think that's a positive signal. And more importantly, if you look at the chart on the left-hand side, you will see that the close correlation with GDP growth is actually for the change in the corporate credit flow. Now, the change in the corporate credit flow is nothing but the second derivative of the loan stock. So, a slower pace of deleveraging already starts to become growth positive in Europe. What we should bear in mind, though, that in Europe the credit cycle lacks the economic cycle, and that's a key difference with the US. In the US, the credit cycle leads the economic cycle. So here in Europe, the credit cycle cannot really jumpstart the economy, but it needs to support it. Now, how do we support it? I think with ECB policies that aggressively drive bank funding costs lower and make sure that banks are adequately capitalized so that the competition in the banking system forces the banks to pass these lower funding costs on to their customers, which in the initial stage will likely cause a refinancing wave, just sort of reducing the debt service burden and freeing funds for other purposes, but eventually also supporting credit growth. And what I'm quite encouraged about in this context is our own work on financial fragmentation. So we created some synthetic costs of financing indicators for euro area countries, both for the households, which are essentially a blended rate of bank loans, and for the corporate sector. And the result of sort of the dispersion of these funding costs you see on the right-hand side. And what you can see is that fragmentation essentially was only an issue for the corporate sector, where the discrepancy between funding costs by country at some point were more than 500 basis points, more than 5 percentage points. This has come down materially with the OMT promise by Mario Draghi, with other measures that sort of have caused funding costs in the periphery to come down materially. And my expectation is that this will continue with the TLTROs, because the TLTROs that the ECB is offering are very attractive to take for the banking systems in the periphery, given that at the moment they pay much higher fees for new deposits that they are taking in. And so I would expect fragmentation to come down further, and I think that's eventually going to be supportive for the periphery. I don't want to spend too much time on one of the external issues that sort of, I think, has caused the recovery to sputter a little bit over in the early summer and over the summer, which is the sharp downturn in the Russian economy, and then the sanctions, and of course the political and geopolitical uncertainty this created. I think this, on top of a marked slowdown in some of the bigger emerging market economies, also has some explaining. Is one explanation of why external demand for the euro area was so weak. But, and I want to close on a positive note, there are some signs that things are turning around. Here I'm just showing you the latest European Commission's business surveys, and you can see that in manufacturing, in services, and in retailing, companies are revising up their expectations. And I think that's a positive signal. We have 2 consecutive increases. They are relatively small at the moment, but they are sustained in the services and manufacturing industry. That, for me, means that the economy is gradually turning a corner. And as a result, we think that we're still on track for a gradual recovery, where growth in the euro area increases from 0.2% quarter on quarter in late 2014 to twice that rate, 0.4% quarter on quarter by the end of next year. That would already be an above trend growth rate. It's not an impressive growth rate, but it would be above trend. And so on the whole, we think that the euro area over the next 2 years will roughly deliver an average growth rate of 1.5%, which I think is decent, but it's not great, and it makes us vulnerable to further shocks, and that is, I think, why the ECB needs to keep pushing with its expansionary policies. And maybe I just stop here because I might be at my time limit. Thank you very much.
Thank you, Mr. Bofinger.
So, something happening? No. Let's start. Okay. Can I start? So, well, good morning. Unfortunately, I can't see you very much because there's so much light on my face, but somehow in the darkness I can see you. So, welcome, everybody. I've now found out why the Greek philosopher Plato has developed this idea of people living in caves, and has developed his theory on these caves, because probably has been in such rooms for some time, and then he developed this kind of cave theory. But I don't want to talk about caves, but about threats to European recovery. And the question is, how can we get Europe back on track? What can we do? What has to be done? And I could do a very easy job just by presenting you the German recipe for growth, because it's a very short and simple one, what I shall do. So the German recipe would be consolidation and structural reforms. That's it. You don't have to be very specific about structural reforms. That's a kind of mantra. You know, if you say structural reforms, everybody's satisfied and think, well, this must be a very, very good economist. You are never asked what structural reforms are. So I once asked an OECD, leading OECD economist at a meeting at dinner, could you tell me the three most important structural reforms that Spain needs? And he said, well, we've written a report on this right now. And I said, could you just tell me the three most important structural reforms? He couldn't name them. So that's the interesting thing. Structural reforms, you just say it and everybody's satisfied. So that's the German therapy for growth. And if Europe is not growing sufficiently, the answer is we need more consolidation and we need more structural reforms. That's as easy as that. And if you ask what is the German contribution to this European growth process, it's also easy. That's that. that's the so-called, what we call in Germany, the black zero, which means we have a balanced budget, and that's what we have to do in order to keep the market satisfied. The trust of the markets is not yet sufficiently strong. No, that's no joke. That's what they tell you. If you talk to people in Berlin, say, why don't we have some deficit? They say the trust of the markets is not yet sufficiently stable, and if we now have a deficit, then the markets will be, I don't know, scared. And I tell them, what would you think the markets would go? If the markets don't buy German bonds any longer, what do they want to buy? But that's a question they don't have none. So, but let's be a little bit more serious. So, what is the problem of the euro area, and how can the euro area get out of the trouble? And in order to answer this, I want to go step a little bit back, and have somewhat longer perspective, and ask what went wrong in the euro area. And if you just look at the growth rates, GDP growth rates from the time when the euro area started, the euro area was not doing so badly, at least until 2007. So it was growing not as strong as the UK and as the United States, but somehow there was some growth, and definitively we were better than Japan. So that definitely was more growth. So the question is, what happened? Why did the euro area have such a bad time after 2007, 2008? And if it's really structural problems, the question is, why did the structural problems just materialize at that time? Because structural problems is something more long-term. That's not something that comes overnight. So is it really that suddenly the structural problems appeared, and since that time the euro area had its problems? And one can, in order, if you want to answer the question, was it really structural reforms? I think it's interesting just to look at the fiscal policy in the euro area, in the UK, in Japan, and the US, and you can see it was a completely different story. While as a response to the crisis, deficits went up tremendously in these three other currency areas where they really tried to fight the recession with huge deficits. In the euro area, almost nothing happened. And so it's not a minor difference, it's a huge difference. Yeah? And if people say, well, if you take the US and the UK, these are definitively countries where most, even German economists would agree, these are the countries that have done all the structural reforms. These are the ideal state of being structurally reformed, and a country like France would never maybe come in the situation of the UK. But even these countries, which are so liberalized, also on goods market, everything is liberalized, they were in need of such a huge fiscal stimulus, which obviously shows that even if you have the best world in terms of structural reforms, you could not get through the crisis without a huge fiscal stimulus. And this fiscal stimulus was simply lacking in the euro area. And I think that's, in my view, the most obvious explanation why things went wrong in the euro area. Because the euro area was not willing to provide the fiscal stimulus that was required to fight this crisis. And even worse, it was not only fiscal policy, which was much more aggressive in the three other country areas, the same thing. Let me just then explain why is this fiscal stimulus so important. It was already said, the problem is deleveraging. And deleveraging you can see easily if you take an indicator which you see at the left, which I use quite often, which is helpful. I call it private financial balances. This is simply if you take the current account and take the current account balance minus the fiscal balance, then you get the private sector balance. And you can see, well, in all countries, due to the crisis, there were positive private sector balances, which is unusual because in the standard textbook, these private sector balances should be zero. So in the ideal fairy tale of economics, the households are saving, and the savings of the households are used by the enterprise sector, and both together make up to zero. And you can see, well, before the crisis, except Japan, was more or less like this, was even like kind of negative fiscal balance, and you could see they went up in all these three, due to the crisis, positive private sector balances, they went down in the US and UK, so it has somehow normalized, but it remained relatively high in the euro area, and the insufficient compensation of this deleveraging by fiscal policy can be seen in the increasing current account surplus of the euro area. So also it was in this crisis, the current account surplus built up, and this shows that there was simply no sufficient compensation of this private deleveraging by fiscal policy, which definitively had a negative impact on growth. So the fiscal response was insufficient. The same thing applies to the monetary policy response. It took a long time until the ECB realized what is going on. And I think the most surprising thing is in beginning of 2011, you can see the ECB even increased interest rates. What a huge policy mistake. How can you do that? Yeah, it's amazing. They have hundreds of well-paid economists sitting around doing research, and the ECB. No, it's really a disaster. How can you as a central bank in 2011 raise interest rates? But really, the crisis was really severe, and everything was there. How could you do that? Yeah, and it took really a long time until the ECB realized that you can go down with your interest rates to zero. That's what the United States, Japan, UK, they all did it much earlier. It took years until the ECB realized it. And in addition, the same thing, quantitative easing. In the UK, in the Japan, in the United States, the central banks were buying tons of government bonds. The ECB did nothing. Same thing. How could that happen? Yeah? So now, I will say a little bit more about that. Now they are considering, but they should have done it 2 or 3 years ago. And they should not have done it in this strange form of OMT, which of course is something where you can ask, is this some kind of support of countries? They should have simply bought the bonds, like the other countries did it. So the Bank of England did not say we make OMT, they just bought it. And the same thing in the US and Japan. So the euro area suffered an insufficient fiscal policy response, insufficient monetary response, and so it's not surprising that the euro area has run in all these troubles. Now, somehow the situation has stabilized. So we have seen that now some positive developments. We were talking about this. You have in Spain and some other countries see some first positive developments. Even for Greece, we have a forecast of a positive growth rate, and also some positive effects. At least employment is not going down further. Some people say, well, now we see, especially in Spain, that the structural reforms are successful. So if you read the report that was published by our council, they say now Spain is the example. This is a model country. If you have really enough structural reforms, it will really work. And also Portugal. But I would say the explanation that the situation has stabilized is again macroeconomic. And it's macroeconomic because now consolidation has stopped. So there is no further, in countries like Spain and also in the euro area, if you go to the very right, you can see the structural fiscal balances in 2013, 14, 15 remains constant. So somehow, that's a positive thing, they've realized too much consolidation is hazardous for your economic health. And Spain is a good example. Spain has a deficit, this is a structural deficit. Spain has a deficit of almost 6%. Last year, this year, next year. Yeah? And so Spain, in my view, is not an example that structural reforms pay off, but it's an example that if you allow countries some deficit, then somehow at least the recession does not continue. I think that's, so the funny thing, not funny, but if the IMF has a so-called group of advanced economies, and Spain has the second highest deficit of all these countries. But in Germany, nobody wants to know about that because they have done the structural reforms, and that's why they are successful. No, it's not true. Yeah? And if you look at the car registry of new car sales in Spain, they've gone up quite a lot. Why? Not because of structural reforms, because of a cash for clunkers program that they've initiated. So, but at least this is, you were saying there are some positive elements. Yes, at least they've realized we have to be careful. France is also an example. They allowed 4% deficit. So this very brutal austerity that has been unfortunately applied to this country is no longer the recipe. And so that's at least some sign of hope. Another sign of hope is that the ECB, at least now in the last 2 years, has realized what they have to do. And I think Draghi has now done a quite good job. He has announced he will increase the ECB balance sheet, which you can see on the right chart, back to the levels that to the maximum levels it had some 2 years ago, which means very strong increase in the monetary base. And so far, at least, it has had a very positive effect on the euro, which has depreciated. The appreciation has been stopped, and it has depreciated quite a bit. And so I think this is also a very, very positive element, because it's much easier to improve price competitiveness by depreciation than by trying to reduce social security contributions, which costs a lot of money and creates a lot of resistance. So I think he has done a good job so far. The problem is whether this announced increase of the monetary base will be really can be really achieved. I think with these targeted long-term repurchase operations, I'm not sure whether it's so interesting for the banks, because if the bank right now the banks get central bank liquidity almost for free, and if they increase the balance sheet too much, the problem for the banks is they will sit on a huge amount of monetary base, which they have to deposit at the ECB at a rate of minus 0.2%. So I think as a bank, I would be very careful by ordering tons of central bank liquidity, because then you have it, nobody wants it, and then you have, you can for the time you borrow it, you have to sit on it. You have to pay money for it, and so I'm not so sure whether this will work. The ECB probably will start buying government bonds, and at this time now, buying government bonds, I think, is a dangerous thing, and I would say mainly politically, because now in Germany we have the problem that long-term interest rates are already very low, and this is really a threat to our private pension schemes. And in Germany, we have the problem that many households don't own a house, so their only wealth for retirement is what they have in some kind of insurance schemes, pension schemes. And now, if the ECB buys bonds, then it also has to buy government bonds, German bonds. And if this reduces the German long-term rate even further, and it would ruin to some degree German pension funds, then the political resistance in Germany against the ECB, which is already quite high, will get even worse. And so I think the positive economic impact of buying government bonds would, in my view, not be worth the political problems of buying bonds. But anyhow, so far the ECB at least has done a quite positive job, and that's, I would say, the positive note. But nevertheless, even if you have positive growth data, as you presented them, the underlying problems will remain, and the underlying problems are first the unemployment, and these are the data from the IMF, which assumes that growth rates of about 1%, and you can see unemployment rates in countries like Spain or Greece will remain much too high even until 2016. So we cannot sit back and say, oh, wonderful, now we have 1-point-something% growth and it's fine. No, the challenge of unemployment will simply remain too high. It will not be sufficient, this 1% growth. And the same thing with low growth and still relatively high deficits. The second fundamental problem, the debt problem, will remain as high as it is. So again, these are the forecasts of the IMF. The debt to GDP ratio will remain very high, which means that the countries will all remain very vulnerable to all kinds of panic attacks by the financial markets. And in fact, of course, this debt chart also shows that how absurd the whole consolidation effort was. Well, it started in 2009-10, say, okay, we have a problem with public debt, and everybody did huge attempts, and debt is higher than before. It was really worth it. So that's it. That's somehow also, that's I think a very, very sad thing. So the question is, what can we do if we are not satisfied with this situation? Well, the answer is structural reforms. And the interesting thing is, if you really look at different indicators for structural reforms, most of them are from the OECD. The interesting thing is Germany is a country which is performing extremely badly in terms of these indicators. I think that's one of what most people obviously only talk about structural reforms without looking at the indicators. So if you look at this employment protection for regular employment, employment protection, temporary employment, the replacement rate of unemployment, the degree of collective agreements, tax wedge, and so on, the global competitiveness index, labor market efficiency, and economic freedom of the world, labor market regulation. And you can see Germany is, at least in several categories, is the worst performer of a group of more than 30 countries. Yeah? So in our report, the majority, we wrote last year, Germany has one of the most heavily regulated labor markets in the world. Yes. You can read it in our report. But nevertheless, it's doing quite well. So obviously, it's not so easy with these structural reforms. I think that's an enigma, I could say. But that's really one of the interesting things that Germany, that runs around teaching the rest of the world about structural reforms, is not a leader in these indices, but it's doing relatively badly, which shows that obviously there must be something else than these structural reforms. And also, which is interesting, is here. So in Germany, the real bad guy is France. So France is really a disaster. Well, some of the political leaders in France are obviously not really examples of very, very ideal politicians. But if you just look at the GDP growth rate from France and other countries starting 2007, France is not doing worse than the UK. And the UK is really ideal, and they are really good, as you can see here. The UK is really doing very well in all these rankings. Yeah? But the UK had, as I have shown you, had very high fiscal deficits. They had depreciation by their currency by 20-30%. They had very aggressive quantitative easing. So obviously, it's not doing much better than France. So the question is, well, if it's not so much the structural reforms, so why was Germany? What has happened in Germany? And I would say Germany did something which was, at least in the long run, to some degree positive for Germany. We had this kind of what we call wage moderation, so we simply did not increase our wages. Also, we were a quite competitive economy in the period. I have here data from 2000 to 2010. Nominal wages, real wages in Germany were almost not increasing. And I think, of course, that has helped us to improve our price competitiveness. And there's a very interesting paper published in the Journal of Economic Perspectives, which says what I already said since many years, but it's nice to have it written in a paper in the Journal of Economic Perspectives. The Hartz reforms are not really decisive. Yeah? And it's obvious, Hartz reforms simply mean if you are long-term unemployed, you get somewhat less money, but this is not something how companies like BMW or I don't know, Mercedes have become so competitive, because you have maybe some people sweeping your rooms at a low rate. So, and the problem here is that this model which worked for Germany is not something we can now apply for all Euro area countries, because this approach only works if nobody else does it. Yes. So that's why and of course we had been profiting at this time from the booming economies in our neighboring countries, because there you had the building boom, as everything was in this period was very dynamic. So this approach had been working quite well. But if now all European countries try this, the only result will be it will end up in deflation, this kind of asymmetric approach. And so it's very dangerous to say, look what Germany has done. It was successful. Yes, it was successful, but only if Germany alone does it and if all other countries don't do it. But if everybody does it, we will end up in deflation. So the question is, what can we do and how can we become more competitive? I think if we do not want to end up as emerging market economies, because the idea of structural reforms, lowering real wages, lowering social protection, means somehow we try to become more competitive by approaching the state of an emerging market economy. That's what it is. So what we really need is more investment, and Elga has already addressed it. It's really frightening how little investment we have now in Europe. So if you compare, this is the average 98, 2000, investment has disappeared. And the question is, why don't we have more investment? The answer is simple: we don't have demand. There's not enough demand. In Germany, for instance, you were talking about why is investment in Germany so low? Because industrial production in Germany today is less than 2007. It's at the level of 2006. So why should German companies invest more if there's no demand? Yeah? So I think that's the problem of this insufficient investment. So once you are in a kind of low growth equilibrium where there's little demand, there will be little investment, and it's very difficult to get out. And of course, if you do not invest, you do not become more competitive. Because the only way to have better products, to become more successful, you have to do more for investment. If you don't do that, you will be stuck in a kind of low growth Japanese-like equilibrium. And the same thing applies if you look at R&D spending in the countries that have problems. Right now, their R&D spending is extremely low. This applies especially to Greece. And if you don't do more in this, it will be very difficult to become more competitive. I stop now. The question is, how can we get out of this? Well, definitively right now, if the private sector is not investing because of a lack of demand, if you have this strong deleveraging, well, the only actor who would be able to do more is the public sector. So definitively we need more public investments. And I think one should, at least as an economist, say what is needed. I think we need the golden rule for investment that has to be re-established in the fiscal compact. It's nice to think about what the European Investment Bank can do and all kind of fudges, but the real thing to do is to have more public investment, and this is something which in the required dose can only the governments do by themselves, and therefore we have, at least as economists, we should ask, please bring the golden rule back to the fiscal compact. And one could have some safeguards, say, okay, if these public investment projects, in order to avoid a waste of money, then maybe they might need an authorization of the Commission so that they check what the money is spent for. And in order to satisfy the German public, maybe one should say also some structural reforms are needed. If the opening hours for pharmacies are longer as a kind of structural reform, and the Germans are satisfied that structural reforms are undertaken, I think then one could add this, say we have a two-pillar strategy, structural reforms plus investment, and we will find the structural reforms that might be impressive somehow. Thank you very much.
Mr. Stockhammer.
Well, good morning. Thanks for the organizers for organizing such an interesting conference and for inviting me to give a paper here. I'll be talking about export debt and austerity. The question of the panel which I'm part was, what are the main obstacles to growth in Europe? And my answer to that will be that it's essentially the economic policy regime that Europe is in. And that policy regime is very much inspired by neoliberal principles, and I think it's this very construction that has led Europe to the crisis that it's in. Now, I think the question that we have to ask is, why a crisis that started in the Anglo-Saxon world, that was connected with the overextension of credit in the Anglo-Saxon countries, why that has led to a crisis that has been worse in Europe than in the US, and in particular one that has turned into a sovereign debt crisis for European countries, but not in other countries. So the story that I'm going to tell is one where in Europe we've had an experience of two growth models. On the one hand, there was a group of countries that had export-driven growth models. On the other hand, there's a debt-driven segment. That's roughly the southern European countries and Ireland. And both of these growth models are intrinsically unstable. Both of them require increasing levels of debt and thus can't be sustained forever. The big difference between the two is that the debt-driven growth model requires the rising debt within the country, whereas the export-driven growth model requires the debt externally. It's the debt of the trade partners that has to increase, but both of them ultimately rely on debt. Now, so far you could tell a quite similar story for the world economy, for say the role that the US and China have played there. What's the big difference is that in Europe we have an economic policy regime that severely restricts the way that governments can react to the crisis, and the previous speaker has already illustrated the point that European fiscal policy was a lot less anti-cyclical than in the Anglo-Saxon world. But Europe also has introduced a separation of monetary and fiscal policy, or monetary and fiscal spaces, I should say, that modifies the effects of monetary policy in the modern way, meaning of quantitative easing. So not only has Europe had a much weaker form of quantitative easing, but in the European setting, quantitative easing, or the central bank lending to commercial banks, and the commercial banks then buying government bonds, doesn't necessarily support the governments that needs it most. So to speak, a Spanish pension fund can choose between buying German government bonds or Spanish government bonds if it wants to have a relatively safe asset in the currency in which it lays its own balance sheet. So in that sense, I do think that quantitative easing or monetary policy works very different in these countries. Now, first, let me illustrate the claim of export-led and debt-led growth regimes in Europe. What you see here is the increases in household debt for various countries, and I'm looking here at the period before the crisis, so roughly the Euro period. And what you do see is that there's a Germanic bloc. You could also add some Scandinavian countries here if you wanted, that essentially had a fairly modest increase in household debt in that decade. In Germany, it even declined. On the other hand, the Anglo-Saxon countries did have substantial increases in household debt. And again, these are increases in household debt, not the levels in household debts, but they are in percentage points of GDP. So in the US, UK, in those 8-9 years, household debt increased roughly by the order of magnitude of a quarter of GDP. In the southern European countries, there was a much stronger increase in household debt. In most of these countries, the starting level was lower. But as we know, for demand formation, it's usually the change in debt or the growth in credit rather than the level of credit that's important. Second, if you look at the current account imbalances before the crisis, you do see the inverse pattern, that those countries that had much less credit growth are the ones that had much larger current account surpluses. German economy in that period had roughly 3/4 of aggregate demand growth in the decade before the crisis was coming in terms of contributions from net exports. and the Anglo-Saxon countries and the Southern European countries, the debt-driven countries, were the ones that were running large current account deficits. Now, that pattern that the period, the neoliberal period with financial deregulation and a pressure on income distribution has led to a bifurcation into debt-driven and export-driven economies around the world. So we could classify the US as one of the debt-driven ones, and Japan and China as other examples of the export-driven model. However, their experience of the crisis was a quite different one. Now, in the early phase of the crisis, the export-driven countries were hit quite hard. If you think of 2008, the German GDP decline was in line with that of the Anglo-Saxon countries, despite the fact that Germany didn't have a debt overhang. What you experience at that point is that the German demand growth, of course, is extremely sensitive to what's going on in the trade partners. Thus, if world trade collapses, Germany feels that big time. Germany, on the other hand, has experienced a quite quick recovery in the early phase of the crisis because it didn't have the debt overhang problem that the debt-driven economies had. Now, in the Anglo-Saxon countries, you have had a massive program of quantitative easing, and you had a stronger counter-cyclical fiscal policy. In the European setting, the European policy regimes, essentially the Stability and Growth Pact, that has been updated and effectively tightened with the fiscal compact, has made it a lot more difficult for countries to run these deficits. So what we then experience in the European countries is that the crisis is getting worse, in particular in the Southern European countries, and it turns into a sovereign debt crisis. And that is quite unique. I mean, if you think about it, the public debt of the US is still about the same order of magnitude of Spain's, and Japan has a much larger public debt than Greece. Both of these countries, the US and Japan, don't have a sovereign debt crisis. However, the European countries did experience a sovereign debt crisis. So there's something about the European institutional setting that gave rise to that. It's not about the levels of debt per se. So what is that economic policy regime? Now, I understand that in yesterday's debate we were often concerned about policy proposals being in line with existing EU treaties. I have to confess that I'm not one who shares that approach. In my analysis, those very treaties are a big part of the problem, and thus there's no serious debate on how we can improve the economic situation in Europe without also putting into question the present EU treaties, in particular the fiscal compact. So let's take a quick look at that policy regime. It is one where we don't have a central fiscal policy, and we have a restrained national fiscal policy. And the fiscal compact, of course, has tightened it recently. It originally had a no bailout clause that was then as the crisis culminated, that was effectively suspended and replaced by first the EFSF and then the EMF. So it did create a sort of a bailout or support system, but with conditionality. The European monetary policy was one that had a strict anti-inflationary strategy, much less of a growth orientation or real targets than in the Anglo-Saxon countries. And financial markets were liberalized as part of the European integration project. Now, in that setting, labor markets have to be deregulated, and the European Central Bank is reminding us of that in every issue of its monthly bulletin. Now, if you think about that, perverse as it is, within that policy framework, that insistence on labor market flexibility does make some sense. It does make some sense in that when you do an introductory class to macroeconomics or economic policy, we typically distinguish between fiscal policy, monetary policy, exchange rate policy, and wage policy as the main policy areas. Now, what the European system has effectively created is a system where you're tying all these standard fields of economic policy to the mast of Maastricht, so to speak, of the Stability and Growth Pact. You're quite restrained in how you can use your fiscal policy. You can only use monetary policy with an eye on inflation. And, of course, there's no exchange rate policy because exchange rates are frozen within the euro area and outside they're flexible, but most of the trade, of course, is within the euro area. Thus, you have a policy regime where among the four policy areas, in a way, the only area where you do have flexibility, potentially, is labor markets. Therefore, within that policy system, you very much do need a flexible labor market because there's nothing else that can adjust. You can't use fiscal policy to react to shocks. And, I mean, the ECB is not quite admitting it, but you could, in principle, use monetary policy. But as far as that's constrained, you're only left with wage flexibility. And thus, we hear, like the amen in the prayer, we hear that we need labor market flexibility. And of course, one could make a case that this is essentially a neoliberal policy package because it does assume fairly strong, makes a very strong case that deregulated financial markets are efficient, that flexible labor markets would bring you back to full employment, and so on. Now, Keynesians have for a long time criticized that policy package, and there's a large literature on it. Essentially, what Keynesians have argued is that labor market flexibility is not going to work. I recommend that we revisit chapter 19 of the general theory, where Keynes is quite explicit that if you have a recession with high unemployment, what you don't want to do is start cutting wages. You do want to have stable wages because wages are one important source of demand, in particular the fuel consumption demand, and if you had wage cuts, you're likely to begin or initiate a debt deflation process. Thus, Keynes was opposed to wage cuts in the recession and said that if you have unemployment, what you do need is demand policy, not labor market reform. The policy package was also flawed in that it created a deflationary bias, that the main adjustment burden was located with the deficit countries or with the countries in crisis rather than with the surplus countries, and that is what we experience in the crisis. Now, in the early phase of the crisis, I co-authored a paper with Dimitris Sotiropoulos that we called The Costs of Internal Devaluation, and that was a time when current account imbalances sort of were more prominent in the debate than public debt. And we did a simple thought experiment that we then backed up with some econometrics. And the question was, well, if it is the case that the southern European countries should react to the crisis by structural reform, and structural reform is really another way of saying wage cuts, how much of a wage cut would we need to balance the current account positions? And if we accept that wages usually depend on unemployment and unemployment depends on aggregate demand in the sense of Okun's law, how much of a decline in GDP would you need to bring about the rebalancing process? And in the net export function that we're estimating, we do have direct demand effects as well as the indirect effects, where lower demand leads to higher unemployment and thus to lower wages. And we estimated that for the panel of euro area countries with different samples and recession dummies and so on. And what we find is that in order to get rid of the current account imbalances that we had in 2007, you would need for, that is a hypothetical average European country, because we're estimating a panel, you would need a decline in GDP in the order of magnitude of 23% to 47%. In other words, you need one or two great depressions if you want to rebalance via internal devaluation. And as a matter of fact, while that was not meant as a forecasting exercise what we did, but sort of a logical exercise in what the order of magnitudes are involved if you're trying to rebalance the books by means of labor market flexibility. What you have here is the simple exercise that I take the trend growth from the decade before the crisis, 98 to 2008, and then calculate an output gap, not like the Commission or the OECD, but as deviation from the trend growth. And what you then find is that you have huge output gaps. You have an output gap for the euro area of close to 15% of GDP. For Greece, you would get an output gap of 50% of GDP. But for Spain, you would also get a 15%, and for Ireland, a 30% output gap. Meaning these are huge numbers. We are talking about output losses that are in the order of magnitude or substantially larger than in the Great Depression of the 1930s. So how has the European economy done since the crisis? And these figures are out of the European Commission's European Economy report. And in the period where we did have some growth, the left side of the figure, the 2009 to 2014 panel, you do see that those growth contributions overwhelmingly are coming from net exports. In other words, the euro area is trying to play the German game, to grow. Essentially, it's a form of beggar thy neighbor policy, and to grow relying on the demand of others. Now, if you take the flip side of that and calculate what internal demand has been in the euro area, it's still less than, around 5% less than what it was in 2008. Whereas if you look at the US, or even at the European countries outside the euro area, they do have substantial contributions of private consumption, and also to some extent from investment. The euro area doesn't have that. It has essentially a flat domestic demand. Now, one important difference in the crisis experience between the US and the euro area regards the development of debt. In both the US and in the debt-driven European countries, we had a quite pronounced decline in real house prices. Indeed, if you look at the data here, while the curves, the blue and the red curves on the right-hand side, do have different time pattern, you see that the real house price indices for the US and euro area are actually not all that different. But what is different is the development of household debt. Essentially, in the US, debt bursting of the property bubble did come with a substantial decline of household debt. Household debt declined somewhere in the order of magnitude of a quarter or a third of household debt, whereas household debt in the euro area stayed essentially flat. That means that Spanish households, Irish households, still have the debt levels that they had in 2008, despite the fact that their houses are worth a lot less. And therefore, you wouldn't expect credit growth, and you wouldn't get a whole lot of aggregate demand. A second important point is that the reaction of monetary policy has been a different one. The Bank of England and the Federal Reserve have pursued a much more aggressive version of quantitative easing. The ECB was much more cautious about that, and indeed from mid-2012 onwards actually substantially scaled back its quantitative easing program. It is now, has announced that it will start that again. Now, in my view, a big part of the reason for that weak extent of quantitative easing is that the European Central Bank has been extremely reluctant to play the lender of last resort for governments. It does accept its role as a lender of last resort for the private sector, but not for the public sector. And from a post-Keynesian point of view, there is a misunderstanding of the role of money and government debt. Money is essentially a private-public partnership project. It is created by private banks, but it's underwritten by government debt on the one hand and central banks on the other hand. And separating monetary and fiscal space is potentially a quite dangerous one. Today's central banks, most of them were initially funded as the bank for the government. They were not funded as the lender of last resort for private banks. That is a function that they typically acquired much later, usually in the early 20th century. But at their foundation, they were essentially to organize public finances. So as far as the European Central Bank is refusing to play that lender of last resort role for governments, that is actually buying government debt when no one else wants to buy it, it is weakening the ability of states to react to the crisis. And in the European setting, the effects of quantitative easing have to be expected to be very different ones for one where you have integrated monetary and fiscal states. If the central bank in quantitative easing gives liquidity to commercial banks, and these commercial banks then essentially buy government bonds, that means that in the US or in Japan, they're buying American or Japanese government bonds. However, in Europe, in the peripheral countries, those banks don't have to buy the government bonds of their own countries. There's other government bonds that are denominated in the same currency, and therefore they can also buy this. So simply put, the Spanish banks can also buy German government bonds. In the interest of time, I'm skipping the discussion of fiscal policy and move on to the last slide. So my conclusion of that is that what Europe needs is a quite fundamental rethinking of its economic policy package, and almost all of the building blocks of the Stability and Growth Pact, the fiscal compact, have to be rethought. I do think that Europe needs a much more inflationary adjustment. That means that a lot more of the adjustment should come from the surplus countries, in particular from Germany. I do think that labor market reform in the present situation is counterproductive. What you do want is a labor market system that can guarantee stable wage growth. And in the current circumstances, I would think that the European social model needs to be strengthened by a system of minimum wages. I do think that European monetary policy would need a higher inflation target, such as to allow a rebalancing without Great Depression in the periphery, and therefore you need a more inflationary setting. And I would also think that the ECB should underwrite government debt much more explicitly than it presently does. I would also think that the suggestions like the Padre suggestions that the ECB takes over, monetizes a substantial part of member states' debt would be a desirable one. Now, let me finish on a Keynesian note on fiscal policy. I do think that sort of in a historical point of view, the experience that we are now having with the fiscal compact is sort of a big step back to a pre-Keynesian orthodoxy in economic policy. I mean, what the Keynesian approach established is that, well, if you do have a crisis, if you have high unemployment, you want to have government deficits. You want the government to shelter society from the impact of the crisis, and thus you do want to have strong budget deficits in the crisis as long as you have these demand shocks. And unless the European economic policy regime allows for that policy reaction, meaning enables countries to pursue expansionary fiscal policies in crisis, Europe is in for big trouble, and ultimately Europe's population will question the usefulness of the euro. Thank you.
Professor Terzi.
This is mine. Yeah, this is mine. Okay. Yes. Okay. Good morning. When it comes to discuss the threats to European recovery, my view is that the biggest threat is that Europe continues to self-inflict fiscal pain. You heard this before, not only this morning. Anti-austerity views have become more popular on the press and in the streets of Europe, but these concerns are countered by the notion that you cannot run away from fiscal responsibility, so you need fiscal consolidation, and it may be convenient to consider why the fiscal instrument got lost and in what ways it can be reclaimed. This will be the focus of my talk, and I'll be delighted to deliver this in Athens at this conference. And I'll begin with a brief overview of the outlook of recovery in early this year by the European Commission, also on the same lines other institutions. And my interest today is on the euro area at large. Regional disparities need a different discussion, and although restoring growth to the overall euro area will go a long way to narrowing the disparities. The CPR dating committee had set the first peak in the lifetime of the euro area in the first quarter of 2008. The 2002 slowdown had not gone by with no major consequence. So basically there had been an expansion that went by nearly uninterrupted since even before the euro was born, 1993. After the 2008 peak, a trough was reached in 2009. The recovery, however, ended early in the third quarter of 2011. And the euro area has been in recession since. Early this year, the European Commission viewed the recovery in, quote, imminent, unquote, with, quote, domestic demand finally overtaking exports as the main thruster, unquote. In the latest outlook, the recovery is seen, quote, not only subdued but also fragile, unquote. So my first question is to see what elements had justified optimism. And more than positive factors, the Commission early this year was looking at less negative factors, basically, which reminds me a guy in a flood where water goes from 3 feet to 1 foot, and yes, it's less uncomfortable, but your feet are still wet. So in the less negatives, so to speak, uncertainty, financing conditions, deleveraging needs, neutral fiscal stance, interesting, definition of the fiscal stance in Europe. On the positives, low commodity prices, weaker euro, lower precautionary savings, therefore more spending, and of course structural policies impact, and a low interest rate environment. In the latest forecast, they show a strong disappointment for investment, but basically restated domestic demand will remain the major driver of growth, except for geopolitical tensions and perhaps some delay in structural reforms in some euro area countries. My preliminary assessment of this type of outlook is that the growth factors appear to be overstated. Less uncertainty about debt redenomination, we've seen this in 2011, doesn't necessarily mean more confidence, maybe less confidence in a quick turnabout of the economy. Less fragmentation. Should we blame banks for being unwilling to raise their exposure in a stagnant economy? Business, should we blame them for being reluctant to borrow to invest? Consumers not keen to lower their precautionary savings and perhaps demanding more. Low interest, not much evidence that low interest fuels demand. And again, should the largest single market, the ambition of the European integration, rely on foreign demand as a structural situation? And is fiscal stance really neutral, or is simply rule consistent, which is a very different definition? When we compare the euro area with the OECD average, which includes the euro area, we see that the deficits are smaller, but they're not smaller because growth is higher, and you see GDP growth significantly lower, unemployment rate significantly higher, even inflation significantly lower. So I walk you fast through this slide because I'm not teaching Econ 101 today, and this is a quick review of the significance of government budget management, which may not be redundant amid some confusion on what austerity means. There are basically two pillars of budget management. One is structural and allocation driven or aimed at, and the other is the standard macro fiscal instrument. And so there are also two meanings of austerity. Sometimes austerity is meant to be government should cut wasteful spending and improve the quality of spending, which one hardly disagrees, although the definition of what's wasteful and what's quality is very politically determined. And of course, the other, what I will use in the notion of austerity in this talk is that government should meet savings targets and reducing deficits. I think we should better take a look at the argument of why the fiscal instrument is of no help. Let's review the logic, because then I'd like to discuss briefly the background, the theoretical background of this position. The idea that the fiscal instrument is not a flexible instrument that you have the privilege of using any time to sustain growth, but only in special conditions and not for too long, is that all individuals or entities are subject to a budget constraint. An economic nation is only a sum of economic agents. Net government spending does create demand by absorbing private savings, that's the idea, and may provide some good And yet, only insofar as those savings that the government has absorbed remain safe. When this condition is no longer met, a government loses fiscal space, and so it loses the fiscal instrument to counter a slowdown. So it's inevitable that the economy slows down if you are running out of fiscal space, and policy should turn to other policies, such as structural policies and long-run policies, low production cost, low debt, and this also generates the view, which is somewhat popular, that that austerity is bad, that austerity does slow down the economy, but the faster reforms are implemented, the sooner austerity can end. So it's painful, but necessary, and you should not undo it because this would mean a loss of confidence and would even be worst. So now I turn to the proposition that it seems to be that the Commission and the ECB models fail. I'm not saying they're using a wrong model, but they fail to use all the available information. An uncomfortable criticism if we believe in rational expectations using all available information. And even remarkably dramatic as this information is within those institutions, at least in the ECB research has produced papers that basically go along my line here. So two major facts missing. I'm listing one, that government budget constraints is institutionally driven, meaning it is not, contrary to household budgets, it's not a natural, ineludible, ineluctable, inescapable constraint and should be judged as such. And that government borrowing to spend adds to private savings, far from absorbing private savings. So let's not lose sight of where these rules are coming from, because this is comes from a theoretical development that kind of restored the idea of sound finance pre-Keynesian in the between the 70s and the early 80s, which I've expanded on a Levy paper recently, and which begins with with a non-unreasonable concern. Any government acting both as money creator and spender may pose a potential threat, not an unreasonable concern. Then the logic continues with government is biased towards overspending, and voters support this behavior. Governments is biased to run deficits, but to avoid inflation, they borrow to absorb the savings rather than print money. But when debt becomes no longer sustainable, then governments have no other option than monetize and then inflate. This is basically goes back to a number of authors, and particularly these one, I think. Fisher in 89 provides kind of an overview of the whole thing. So the solution to this problem is a two-pillar solution. That is the creation of an institutional budget constraint that has two pillars. One, transfer the monetary power to another guy with no spending authority, so you solve the first problem. And then set deficits or debt limits. Different countries do it differently to the spending authority. Now, if we bear this in mind, now is deficit reduction in Europe now aimed at avoiding inflation? I think we've even lost the sight of what was the rationale at the beginning in the standard economic theory of Friedman, Buchanan, and Fisher. Fisher's concern is that not that governments go bankrupt, but that inflation is almost always a fiscal phenomenon. He was basically not contradicting Friedman, but reinforcing Friedman, so to speak, saying that inflation is a monetary phenomenon, but money printing is a result of excessive debt when fiscal space is gone. And the central banker concedes that it's very difficult for us to reach the objective of inflation only based on monetary policy. This was Draghi in the press conference in September. So it seems that the institutional budget constrained solution was tailored to prevent inflation. And I understand that we are searching for inflation desperately at this time, offers little justification for austerity at this time, and of course it supports the narrative that we really ought to monetize to see recovery, because the idea of the Friedman, Buchanan, Fisher idea is that when governments rather than borrowing, monetize, or when the central bank swaps government bonds for money, that's when you see inflation. Except monetization is really not enough. Monetization during the gold standard was withdrawing a claim on gold. Today is withdrawing a central bank liability with zero interest rate and swap it for another liability that carries a yield. That's all it is. And all government debts are sustainable when the central bank has a bid and an ask price for treasury securities. So in this last part, I would like to tackle with the second missing point in the EC and ECB models, and with the notion that governments borrowing to spend funds private savings. Savings are funded. Savings do not really fund. Savings are funded. And when government borrows and spends, it boosts the stock of net financial assets of the private sector. This is pretty much largely recognized and is expressed in a simple identity that is seen nearly in every single textbook. National savings is zero if the trade balance is if the trade account is balanced. So if the trade account is balanced and national saving is zero, it means that net private saving is equal to government deficit. As if government deficit is bigger, net private saving will be higher. And but let's see private savings in action. These are the for the euro area. This is the household's net financial savings through 1999 through today. So this is the unspent income flow of households, net of any expense on housing. This is the financial corporation's net financial savings. So it's profit net of investment in real assets. It seems that investment in real assets never really exceed profits in financial corporations. And although this difference has been getting bigger recently, non-financial corporations, we've seen this before for Germany, same notion, profits minus net investment in real assets, typically negative, and positive when corporate investment drops. So when investment is at its lowest in a stagnating economy, then this is when you see this positive. This is the net savings of the foreign sector. Well, you see the up and down, the yellow. So it's up and down. And recently, there is a net financial dissaving on the foreign sector, which means net exports, right? So those that yellow at the very end of our timeline, it's the net exports of the euro area being positive and significantly positive as compared to this recent history. So this is government. And you see a largely automatic response, cyclical response of government deficits. And these are all sectors. And here I've added the investment rate, the corporate investment rate. That's a proxy for the business cycle, nearly equivalent to the unemployment rate in inverse fashion. And two observations. The household's net savings have been moving anti-cyclically, somewhat contrary to traditional consumption functions, but a fact that Josef Steindl, in an article in 1982, had already called the attention on, that he explained with the rising importance of consumer credit and the higher consumption elasticity to income. But the interesting thing is what happens after 2010 when basically with austerity. The household savings seem to be forced down rather than being a sign of confidence and spending, right? Because in the anti-cyclical behavior of savings, savings go down when households feel comfortable and spend more. But here you have very low investment, very low household savings, and this connects very strongly with government deficit. That is anti-cyclical, as we've seen here, but after 2010, it becomes pro-cyclical. And is forcing compression of savings down so that you have a significant amount of unmatched, unsatisfied demand for precautionary savings, which translates very quickly into recession. And probably the euro area was going to crash if it was not for that yellow area that supports the savings. That's the net exports. Now, the fiscal instrument can be used in different ways, can be engineered, can be set free to adjust, or blocked, as it is right now. I think it's basically responsible for monetary unions to block the fiscal instrument at the sub-federal level, so to speak, to avoid competition on who runs the largest budget deficit. But the euro area had first let the deficit adjust, or the fiscal balance adjust, to insofar as excessive deficits were just national stories. And that was before 2010. After that, the euro area has irresponsibly blocked the fiscal instrument when excessive deficits were posing the question of in the bond market. One last word on the fantasy world of balanced budgets. This is the world where Europe seems to want to live in, and it may be for a while, but it won't be forever. Because balanced budgets are not sustainable. This fantasy world looks like this. Government deficit measured horizontally, so that position of this world economy, closed economy, is on a balanced budget, and the 45-degree line simply means that the trade balance, the trade account is balanced by definition because it's a world or it's a closed economy. So you've got to be there. If you have a balanced budget, you also have net financial savings equals 0. If you moved northeast, you would see an increasing stock of net financial savings. If you move southwest, you would see a falling stock of net financial savings. So the question is, if you have a demand for savings that may be partly endogenous and partly even institutional, just think of pension funds, how much savings they collect each year, then you got to be in the northeast region, somewhere there. I said I would not discuss regional disparities, but just a very quick word. If the world is now composed of two nations, one is the net exporter, one is the net importer, they would simply place in that symmetric position. Well, not necessarily symmetric position, because if private debt may move that point on a parallel line, but basically the net exporter, given private debt stable, would see a government deficit smaller, and the net importer would see a government deficit bigger. The net exporter will produce more goods to be consumed by the net importer, and vice versa. And if the net importer becomes more competitive, then you just converge to the middle. You can't all be on the left-hand side for obvious reasons. And the cyclical adjustment of the fiscal deficits that basically functioned up to 2009 or 2010 is driven by a change in demand. When demand declines, that blue point will move northeast or move southwest when demand increases. And so this takes me to some concluding remarks of this quick review of how savings do not fund, but they need to get funded. And the major source of funding is government net spending. And in this framework, the deficit reduction policy, number one, it underestimates dramatically the direct stagnation effects that this policy has on the overall euro area. I also believe it overestimates the expansionary power of monetization for the reasons that I said earlier. Swapping an asset with zero interest rate with an asset with high interest rate does not create more savings, except for in fact, it reduces the savings, right? Because you withdraw government bonds yielding a positive interest rate, and you replace it with a zero interest rate liability. So it might in fact have depressionary effect more than expansionary effects. It pressures government for downsizing, and this is the mixing up of the idea of austerity that I was talking about earlier. So it's not just the deficit that matters, but also the size of the government sector, which is a different question, and also a question that clearly requires legitimacy, and so this poses a question for Europe. And okay, I should perhaps go into some effective solution to the euro, but in a way I'd rather not to, because the sensible solutions depend on whether the model is correct or not. So if you have the correct model, then the solutions can be really very many. And it's all a political question to see what's the most appropriate. But perhaps Europe would need the use of a fiscal. I mean, first of all, you would need a fiscal instrument at the union level within a credible framework, which, okay, can be done with a political union, but I think it can also be done pro quota in a way that doesn't require a transfer union. And two, that we need to boost institutions. I'm a bit skeptical about big overhaul changes like eliminating the fiscal compact, which to me seems a political change that it's very hard to obtain. But adding institutions more than changing or subtracting institutions. For example, a new economic council that evaluates the overall fiscal impact and sees whether the fiscal impact is near to become inflationary. At that point, you say, stop. So if you look at the deflationary situation now, that's not the way to say stop. And, well, perhaps consider, but these are, just my bias, but, well, before disintegration, that I strongly believe, before disintegration comes, which is a true option, and perhaps even more likely after seeing how hesitant has been the politics in Europe in this last year, especially after the European elections. But we can discuss a 50% cut of VAT funded by union bonds pro quota. We can discuss, as we have in this conference, investment funded by maybe EMS, EIB, with bonds guaranteed by the ECB. Well, guaranteed by the ECB simply means that the ECB is allowed to set an ask and a bid price for those bonds. That doesn't need actually and necessarily to buy those bonds, but as soon as the ECB has a bid and an ask price and does monetary operations using those bonds, that's fine. The big problem of the debt sustainability is also, among other things, in a particular operation that ECB has adopted since start, and that is that contrary to other central banks, the ECB is not buying and selling government bonds because they would have to buy single countries' bonds, and they rather not to. But they finance the banks on repo operations with collateral. So that's not setting a bid and ask price. This means to accept what the market price is for those bonds, put a haircut, and then use them as a collateral to refinance banks. But I'll leave it at this way. Thank you very much.
Well, thank you. I want to put a question to all of you, because I think at the heart of the problem here, obviously, is Germany and the economic policy Germany is following. And the question is this: I mean, do you think it's politically feasible that is going to change? And if that does not happen, what would your prediction be? Is Europe going to be muddling through for a while? Or is something like disintegration or a Euro breakup possible, like Professor Terzi just implied before? Let me start with Professor Bofinger.
Yeah, thank you very much. As far as I know the German politicians, I don't think that there will be very much change in the next few quarters at least. And as long as there is not an outright recession in the euro area, I don't think that this addiction to balanced budgets will change. So I think that's in all government parties. I think also the Social Democrats are not considering right now at least investment initiatives for Germany that are debt financed. And so I think Germany will not change. It's really frustrating, I must say, when you talk to government officials in Berlin. They discuss economic policy as if Germany was an island. Was an island without any connection to Europe, and they don't see this kind of systemic approach that, of course, Germany can only prosper if the euro area prospers. And if there's weak investment in Germany, I think maybe this can also be explained by the fact that, of course, investment in Germany is investment for the euro area. If you want to invest for China, you invest in China. If you want to invest in the US, you invest in the US. But investment in Germany is investment for the euro area. And as long as the euro area is not doing better, that won't change. So my forecast for German policy making is we won't see very much change, and we will. I assume that we will have this kind of stagnation. I don't see a real recession, because you can only fall down if you have did climb something, but if we were now in a deep valley, and so I don't see a real downward risk, but I see this stagnation risk, and as I've shown it, that's bad enough, because with stagnation, unemployment will not go down, and the fiscal situation will not change, and the debt situation of private households will not change, and so the whole system will be very vulnerable to all kind of political groups who say, well, this is an absolutely unacceptable situation, and so there is also some risk that one of these political groups, be it in France or in Greece, somewhere else, will say, let's get out of the whole thing. And so my forecast for the euro area is quite somber, unfortunately.
You want to comment?
Yes, I'm not sure that it's sort of the German fascination with balanced budgets and badly designed stability and growth pact to be blamed for the fact that Europe had to front-load its fiscal austerity much more than the Anglo-Saxon countries. I think we need to look much more to an institutional flaw, if you will, of the monetary union, and that's the fact that the ECB is not a lender of last resort for governments. I don't think that the US or the UK funded at such low rates at the height of the crisis because they were in much better economic, fiscal, or political shape. They did fund cheaply at very affordable rates because no investor had to lose sleep over whether or not they would get their money back. And I think this is very important, because only if the government can fund at very low rates and at falling rates within a deteriorating situation for the economy or the financial sector, it's only then that you can actually follow the advice of Lord Keynes and do a counter-cyclical fiscal policy or stabilize your financial system. If the markets don't allow you to fund it, you're having a proper emerging market crisis. And I think the question, much more than trying to redesign the Stability and Growth Pact, the Fiscal Compact, is to ask, under which conditions would Europeans be ready to change the European Treaty to allowing the ECB to become that lender of last resort? And I think, for me, that probably needs more fiscal integration, potentially also to make the Germans comfortable, a commitment to fiscal discipline, but this stability factor is of the essence. And at the moment, the ECB is operating somewhat in a gray area with an OMT promise, which is trying to sort of make a promise, maybe with the purchases of government bonds going forward. But at the end of the day, it is a little bit of a gray area, and that's, I think, also why the ECB initially, in the crisis, did choose a form of indirect quantitative easing, where they basically offered unlimited and very cheap funding to banks so that the banks could buy the government bonds rather than the ECB themselves. We had, I think, some quantitative easing. The ECB expanded its balance sheet. It's expanded the excess reserves in the banking system, but it could not do it with its own balance sheet. But at the end of the day, this lender of last resort promise is very important. In my mind, it's a reinsurance mechanism, but it's the credible commitment to investors that you can pay back the principal of a government bond under any circumstance. Ideally, I think you should use it. You shouldn't use that reinsurance mechanism, because as we saw, for instance, with Banca d'Italia in the 1980s, that sort of sets let's say, destructive mechanisms into motion, but to have that promise in the background is extremely important for the stability of the government bond markets, which can either facilitate pro-cyclical counter-cyclical fiscal policy or actually prevent it. And I think that's really at the heart of the problem in the euro area, rather than the Stability and Growth Pact.
Any of you want to take a pick at this?
No, I don't think I can add much on a positive note as regards German economic policy. While I'm only a casual observer of it, my impression is that it does not, in terms of the main political parties, it does not fully grasp the European dimension of what Germany does. And that is indeed very worrying, because ultimately the monetary union, I don't think, can survive if Germany sort of plays by its own rule and does not realize the external effect its policy has. Now, I'm a bit more worried about the stability of the whole thing. I mean, I'm not sure how long European societies can survive a situation of unemployment rates of around 20% in many countries, and I don't see any improvement. Now, what has changed compared to the crisis 5 years ago is twofold. On the one hand, the economic policy framework as regards fiscal policy has become tighter. As regards monetary policy, central bank support, it has become more flexible. And therefore, if there were another crisis, in a way, countries are a lot less equipped to respond to that. Because, I mean, if you think of either another crisis emanating from the financial sector, don't forget that banks are still extremely fragile creatures, while there have been all sorts of effort to boost their capital. If you look at the balance sheets of any of the major banks, their capital is 3-4% of their assets. So, I mean, if you have another financial shock, banks are again in big trouble. And in the present situation, it would be extremely difficult for governments to go to deficit levels that we had in 2008. I mean, it's very hard to imagine another financial crisis and European governments having budget deficits of close to 10% of GDP. So whether it's from the financial sector or from a political crisis, where the instability comes from, I don't know, but I would be very worried how long this system can survive. In other ways put, I do think the present structure of fiscal policy, the fiscal compact, is really a suicide pact for the euro area.
Yeah, it is all very worrying, yes. Yeah, and I share the view that a collapse of the euro would be really disastrous for the whole process of European integration. So I think we just need to do all that it's possible and impossible to avoid such outcome. But again, I don't think we need to change the treaty to have the ECB becoming the land of last resort if the euro area decides to use the fiscal instrument. The treaty does not prohibit the ECB for placing a bid and an ask price on European Investment Bank bonds or a new union bond. I'm more skeptical about the QE on government bonds. First of all, I don't think there are the political conditions for Draghi to do that. But even assuming that he does that, then we would be back to square one in terms of size of deficits that should comply the rules. So that wouldn't be using the fiscal instrument as I was trying to propose, and also the QE as such is really not an instrument to create more credit. Bank credit is goes up with the quality of the borrower, the expected return of the bank, which depends on the cost of funding. The cost of funding, not the quantity of reserves in circulation, and the capital ratios of the bank. So if all these three things are positive, there's no reason the bank would not lend because they have not enough reserves or because there are not enough quantitative easing around. And again, just to reinforce my point, any discourse about debt is a discourse about savings. So reducing debt means reducing savings to the economy. So do we really want that? So yes, it's very worrying. But you know, you never know. Sometimes Europe has surprised us. It may be possible that in the next century we'll look back at the Euro disaster, if there is a Euro disaster, and perhaps assess history by, you know, with the idea that Europe came out of World War II with so many pain, with so much pain that they accelerated the process too fast, and they wanted to move to the single currency when it was too early, and then it went all in a disaster. Or things may change. We may even think of a scenario where Germany opens up to some idea of political union with a strong transfer of sovereignty from countries to a high level, and see France blocking the process next, right? So this is really true uncertainty in terms of what's, but I think we know what disaster we want to avoid.
Okay. Since we don't have that much time, let me open the floor to microphone. Ένα λεπτό έρχεται, κατεβαίνει. Μόνο να μπορεί να κρατήσει σύντομα τις ερωτήσεις λίγο.
Από το Τμήμα Ευρωπαϊκής Πολιτικής του ΣΥΡΙΖΑ. Όπως διαφάνηκε από την πάρα πολύ σοβαρή συζήτηση...
Μισό λεπτό να βάλουν τα ακουστικά.
Όπως διαφάνηκε από την πάρα πολύ σοβαρή συζήτηση, και χαίρομαι που σήμερα βρέθηκα εδώ και άκουσα τόσο έγκριτους επιστήμονες να παρουσιάζουν το θέμα, έχει αποδειχθεί ότι η Ευρώπη με την ηγεμονία της Γερμανίας δεν προχωράει. Και υπάρχει μεγάλη αβεβαιότητα ή πρόβλημα και ενδεχομένως και διάλυση. Εγώ λοιπόν θα αντιστρέψω το ερώτημα και θα πω, είναι δυνατόν να αλλάξει πολιτική, και αν αλλάξει πολιτική υποθετικά από τις υπόλοιπες 27, από τα 27 κράτη-μέλη, η Γερμανία μπορεί να ακολουθήσει και θα ακολουθήσει, αφού το δικό της γερμανικό ευρωπαϊκό πρότυπο αποτυχάνει. Και εν τελευταία αναλύση μπορεί να γίνει αυτό, να μείνει απ' έξω η Γερμανία και να δούμε το όραμα της Ευρώπης να πάρει άλλη διάσταση και άλλη προοπτική.
Κάποιος άλλος, κάποια ερώτηση?
Hi, Polychronio from the Levy Institute. I have a question for actually any one of the speakers. It was delightful to hear the expressed criticism toward German economic policy, but I think there's a gap in the sense that all economic policies rest on certain fundamental ideological principles, beliefs, what might have you, which by definition they imply that they serve certain specific interests. I mean, economic policy for the sake of economic policy doesn't exist. The same thing goes for an ideological framework. So the question is, what specific interests is German economic policy serving in the Eurozone? We haven't heard that. The second part of my question is, if the current economic and social situation in the Eurozone, especially in the southern part, is so catastrophic, as you have described it, and as it is, why is everyone so afraid of a fundamental change in the Eurozone? Not going forward, but perhaps going backwards. Thank you.
Ευχαριστούμε. Κάποια άλλη? Μικρόφωνο στο κύριο πάνω.
Thank you very much. First of all, I prefer the American model. They have the Full Employment Pact of 1945, so they give a priority to employment. Secondly, why does Germany stick to what happened during the German hyperinflation of the 1920s and does not think what happened in Germany after the war, the Second World War, from 1945 to 55, when they were poor and miserant? My question now has to do with the following. After the subprime crisis in the US, there was a lot of criticism towards the rating agencies, especially the international or the American ones. They are the only ones, by the way. Germany and France at that time supported the idea of introducing a European rating agency. And by the way, this has been discussed during the making of European banking directives in the 1990s. So why does not Germany initiate common European practices, including the common rating agency? Thank you.
Let's start backwards. Start with Professor Terzi first, and we'll move on. We'll start with you.
Well, these questions have more to do with the divergence, perhaps. Then I will, let the other speakers respond. Maybe I can comment briefly on the on the possible change of mandate of the ECB. I'm a bit skeptical about whether that change anything. And I'm sorry to go back to my line. Unless you recognize the fiscal instrument be an instrument and not be something that is only available under very special circumstances, only temporary as long as the country has a fiscal space, then the game is changed. There's no reason to change the mandate. The employment is one of the objectives of the European Union and is one of the objectives that ECB should pursue if this doesn't, as we all know, the letter of the treaty doesn't affect price stability. And I would, and perhaps I would also add that in the U.S., where the mandate is explicit, there also, of course, it's a much better world in terms of the use of fiscal instrument. But look at what's been happening recently. Lots of concern about the debt-GDP ratio in the U.S., largely a political battle, but also a concern for the sustainability of the public finances somehow. And yeah, it's more a political question than an economically driven discussion. But nevertheless, the result is that the deficit GDP ratio now in the United States is smaller than in the euro area. And this might, in fact, be a reason for slowing down the U.S. economy, as some worries have been become transparent recently.
There were several questions about German political economy effectively. Now, I should say that while I might have a German accent, I'm actually an Austrian. Thus, it's not an inside view. I guess two thoughts on that, maybe three. I guess it's important to realize that the economic situation in Germany is a very different one from the southern European countries. I mean, Germany, Austria, the Nordic countries have had a relatively mild recession. I mean, they've had a recession with a recovery. Unemployment is lower than it was before the crisis. So it is a matter of fact that for the population of these countries, the reality is a completely different one than for the southern European one. And in that sense, there's not a whole lot of pressure on politicians to change something. I also think we should not completely underestimate what has changed within Germany. Germany originally didn't even want to have the limited bailouts. Germany did have a very strong Bundesbank that effectively has been disempowered within the European Central Bank. So, I mean, while the speed of change is completely out of proportion to what the south of Europe means, it's not like that nothing has changed. In terms of capital interest or the interest behind it, I do think it's a bit puzzling what we're experiencing, and it's hard to square the German policy stance with a simple sort of interests of German capital story, because you would expect that the export-oriented industry does have some interest in at least viability of the economic models of the trade partners, but obviously that's presently not of very high concern. And German politicians are quite inward-looking. But on a fundamental level, I guess one shouldn't expect Germans to discover their inner altruism in the face of the crisis. I mean, what one could have expected in the crisis is that there's a shift of economic policy from the national level towards the European level. And in terms of fiscal policy, at least, that hasn't happened. In terms of monetary policy, I do think to some extent that has happened, and the ECB has emerged as a stronger player, and Germany and the Bundesbank is a weaker one. So in that sense, I do think there has been some change, and the European Union has a history of only changing sort of at gunpoint, at the situation of big crisis, and therefore if there's another wave of crisis, it might well be that European economic policy consolidates. But again, I think what we should be looking for is not the inward-looking Germany and what's changing there and why they're not looking at the other countries, but really why is not more of the powers shifted to the formation of a European state.
Okay, so what are the special interests behind the German approach? Well, I think it has now really become a kind of, it's not something rational. I think it has really become a kind of theology, and it's a kind of pro-market, anti-government ideology. Of course, it's somehow supported by interests of the enterprise sector, so they get funded from all kinds of think tanks. But right now, I think it's really something that has its own momentum. This kind of anti-government, pro-market, and this ideology is now being transformed to the rest of Europe. I think that's what the German approach is, and I think it's not very rational, as you said. I think for business interests, it would be better to keep the rest of Europe in good shape, because that's our market. I think that's what we have a kind of almost masochistic approach, saying bad things about France, but that's our best customer, which we don't realize. So it's not a real rational approach. It's really this kind of irrational, anti-government, pro-market approach, and which is astonishing after we have experienced this financial market crisis, that this ideology has become so strong again. But I do that every week, going to all kinds of talk shows and discussions, and I can tell you it's a difficult job to fight against this ideology. So that's really difficult, and I'm not sure it will change. So in the near future, I think the only possibility for a change is maybe that we get another really serious crisis, which I also think is not a good idea. But that's the only situation where we could see a change of this. Just and the idea, somebody asked, why is Germany not looking more to the history, and why do Germans only look to the hyperinflation? I think what Germans should do much more, they should look to the depression in the early 30s, where the interesting thing was that in this depression, the German Chancellor, Mr. Brüning, at that time, he had a completely balanced budget. Yeah? So that in this whole period, and of course he prevented what you said by having this balanced budget, he prevented the deleveraging of the private sector, and of course it was a disaster. And so I always find it very, very strange if Germans say, we from our history know how dangerous inflation is. We should say, we know from our history how dangerous it is to have balanced budget in a crisis, because that was really what paved the way for all the terrible things that happened.
Yeah, I mean, it seems to be a sort of received wisdom that the defining moment of US monetary policy making was the Great Depression, and that the defining moment of German or now European monetary policy making is hyperinflation. But I don't think that's completely accurate, because if you look at the post-war history, the reason why the Bundesbank was made independent was actually a desire by the Allied forces to critically limit the power of any future federal government. And initially, the Bundesbank would have taken orders from Allied forces, and then only when Germany sort of became more of a state again, the Bundesbank became completely independent. But the key issue here is, of course, that to control a government effectively through national parliament, and thus through the population, you need to make sure that every cent the government wants to spend, they need to get parliamentary permission for. And I think this is why we need to think about also making the central bank a lender of last resort quite carefully. So I don't think it had to do that much with hyperinflation. I would acknowledge, though, that Germans, with hyperinflation, but also with several currency reforms after the Second World War and then after German reunification, Germans are very aware that also money is only a promise printed on some paper, or increasingly an electronic promise. Someone asked why Germany doesn't leave Europe or the euro area, and allows everybody else to move forward. I would say that, first of all, at least my understanding of the European Union and also of how the euro came about is that it in part was created as a post-war peace project with a strong desire to bind Germany into the European family. And I think, especially when we look at financial market dynamics and why everybody was so keen to join, to first peg to the Deutschmark and then also to have a common currency and dilute the power of the Bundesbank, if you will, is of course that Germany was the stability anchor in Europe and was able to have very low interest rates. Now, I would actually be somewhat concerned whether Europe without Germany could actually be able to sort of stay united, because there are a number of other countries who have pretty similar economic models, big current account surpluses, Austria, the Netherlands, some of the smaller countries, but also, of course, the whole Nordic region. So I think stability in Europe without Germany might also be an illusion. But I think what Germany needs to ask itself very seriously is why it prefers to export capital abroad instead of investing in its own future through infrastructure investment, investment in education, R&D, and so on, because that's essentially what we're doing with running a major current account surplus. You're exporting an enormous amount of capital, and in many cases, you would, if a company would do something like that, you would probably look at it as vendor financing, and that many corporate experts will tell you is a rather risky business model.
If I may, just a quick statement on the mandate for full employment again. Irrespective of where and how that is written, what made this mandate more powerful until the 1980s was the protection from communism, and that's gone now.
I want to thank you for a very sober analysis. I wish some of our current and perhaps future decision makers would be here to be exposed to all of this, but thank you very much for being with us.